Right, so welcome everyone. Welcome to this week's group call. It is Wednesday, the 5th of November 2025. How this year has flown. Hope everyone's had a good year, both financially and, of course, more importantly, health wise. That's the main thing, right? Because without your health, nothing else really matters, right? Puts things into perspective. So, um, yeah, hope everyone's doing well, and a warm welcome to all of the new traders that have joined. I see Brian in here, and I'm not Mohammed. I don't think Mohammed is new. I'm not too sure if you are Mohammed. PTOP as well. A couple of the new guys, right? So for the guys that are, the usual. They've been here for a while. I'm just going to take maybe the next 15 minutes, possibly maybe 20 minutes, just kind of run through really the trading 180 ethos, I guess, what I kind of my approach to trading and what I'm about. And then we'll get into the fundamentals and the technical side of things. So just a quick rundown of my approach to trading 180, and really my goal is to identify and to help you to identify value, right? Because for me it's about premiums and discounts and using a combination of fundamental risk sentiment and technical analysis, going long and short, the rumor, and to confirm with the data, right? So what we're doing is we're buying the rumor by understanding, present and future value, and in Forex. And so our focus, really how we kind of get to that, and kind of determine that, especially in Forex, is really about interest rates. So divergences in interest rates. Interest rates are a central bank's way of trying to appreciate or devalue the currency, or by holding rates, then they are satisfied with where the value of their currency is, right? And in terms of, that's really driven by two main things, which is inflation and GDP. So inflation is really just prices, and so central banks have a 2% target, inflation target. Some central banks have a dual mandate, so they are mandated to get employment at a certain level as well, or keep employment around a certain level. But mainly, all central banks will focus on inflation and have a 2% target. And so central banks will hike, hold, or cut depending on where inflation and GDP is. And so I would definitely advise you guys, if you haven't, take the short course and test within the Discord area, because then you'll have a game plan really for every eventuality that our current economic system and inflationary system can kind of throw at us, right? And we'll know what to do in any environment. So risk event. Of course, risk events do determine central bank interest rates as well. It's more on the rarer side. The event would have to be, pretty severe. So the last event that really kind of drew, I think, central banks into rate cutting cycle, and I guess they were getting ahead of inflation and getting ahead of GDP, was during COVID. You've had that the last 5 years. You've had the uh, Ukraine and Russia financial, Russia and Ukraine war. So that was something that central banks had to kind of get ahead of as well. And so there are events that do cause risk events that do cause central banks to hike, hold, or cut rates, but typically it's more driven by the GDP, the business cycle, and inflation. And in terms of directional confluences, right? I'm not the kind of person that's gonna, there are many other traders out there that will attempt to pick the direction for the day or for the week. Yeah. I'm not one of those traders. I'm one of the traders that can predict, and for many of you who have been with me for a while, will definitely see my track record in terms of directional biases. My directional bias on a with trades and currencies, in terms of I'm more looking at the medium to long term directional biases, right? So um, I can tell you what's likely to happen over the medium to long term, um, with certain currencies. Not all currencies are going to be clear at all times. I just want to make that clear as well. There are times where a currency, there are reasons to buy a currency and there are reasons to sell the same currency, right? But what we're looking for mainly are for the clear, confluences, the clear direction on a central bank, whether they're looking to, hike, hold, or cut rates, and then compare that with another currency or another central bank which is looking to do the opposite or do something different, and then you'll know whether to buy or sell. And we kind of get that and those directional confluences from central bank statements and comments, right? First and foremost, if a central bank is hawkish or dovish, I post that, obviously, that kind of news in the Discord area, and that will really be the driver, one of the main drivers of why we would be long or short, right? Because, like I said, central banks are looking to control their currency and value their currency via monetary policy. So one of them being, or the main one being, of course, interest rates. They do other things like quantitative tightening and quantitative easing at the same time. Intervention is another one. We'll talk about that a bit later with the Swiss National Bank, and and those are really the main kind of three ways to kind of control their currency, right? But we'll read central bank statements and determine whether they're hawkish or dovish. Government bond yields is another asset class which should be kind of looked at. And again, I have a Discord channel, a couple of Discord channels about bond yields, and really the long and short of it is that treasury bond yields are a good indicator as to what bond traders are currently thinking about inflation and the economy. And so if you see bond yields move to the upside, it's usually and typically an indication that future interest rates are likely to rise. And if you see them kind of moving down quite a bit, and again, we're going to get into this in a sec, you'll see bond traders kind of expecting rate cuts. So bond yields, and they work in opposite to bond prices, right? Bond prices do the opposite to bond yields. So bank forecasts and analysis, which again I typically will post in the relevant Discord channels, as well as additional things like the COT, commitment of traders, and seasonality. Of course, a commitment of traders, I don't think they've really been publishing the data since the government lockdown. So unfortunately, anyone who's been depending or using COT data, hasn't really been getting anything like that. But it just goes to show you really that you don't necessarily need COT data to continue to trade, right? And continue to understand really what's going on in the markets. Again, I always see COT as just that extra bit of confluence. It should never be used, in my opinion, as a leading indicator, right? Because for several reasons, the information that you're getting obviously lags in terms of it's from the previous Tuesday, or that week's Tuesday, for the previous week. And if you understand what central banks and institutions are looking at anyway, they're looking at the same things that we're looking at, or we're looking at the same things they're looking at in terms of interest rates, inflation, and GDP and risk sentiment. So, again, this is the last maybe month or so without the COT data. We haven't panicked about that. Many traders probably are panicking and maybe losing in terms of trading, or maybe not. But at the end of the day, we don't need COT to be profitable at all. It's just that extra bit of confluence. So when you see obviously institutions, certain hedge funds, or the asset managers maybe going in a direction that you're already going in, then it just adds extra confluence to your trade. And of course, seasonality. Now, what we want to do is identify value from a daily and weekly time frame chart perspective. So we're looking at highs, lows, higher highs and higher lows, or lower highs and lower lows. And at least, depending on the pair, about 150 pip, minimum auctions ranges. And we're looking at chart time horizons, like the 1 month, the 3 month, year to date, and 1 year on trading view. So I know many of you do trade using MetaTrader. I haven't used MetaTrader for donkey's years, but in terms of charting, but yeah, that's really what I'm looking at. And the reasons why I look at really the higher time frames is because the higher time frames give you a better perspective of how big money is moving, right? And where big money thinks that a price is either on the expensive or the cheap side, right? So as an example, and I know everyone knows what the charts look like, but in terms of understanding recent, or the last up until probably around June, right? We've been auctioning between the 119.20 and the 113. So ultimately, what this is telling us, yeah, prices is between these two, right? What this is telling us is that the big money, right? It takes a lot of money to move prices, to the downside, hundreds of of pips, 800, 900 pips, right, to the upside or to the downside. And so what this is telling us is that institutions, asset managers, hedge funds, think that this area is expensive in terms of an exchange rate, and this is cheap in terms of an exchange rate, right? That's what this is telling us, and it takes a lot of money to move that. Whereas if traders are kind of going down into that lower time frame and looking at maybe something like maybe a weekly time horizon, or maybe 5 minute levels, it doesn't take a lot of money to move price maybe 15, 20, 25, 30, 35 pips in comparison to looking at it from a daily or a weekly perspective, right? So these are the more the daily levels, the weekly levels are more significant. Now again, some traders will look to predict where price is going to go for the week, right? And where price is going to go for the day. Great for them, right? I could never really do that. My skill set lies in the higher time frames and looking at and understanding where prices are likely to go over the next month, 2 months, 3 months. Looking at where it's cheap from an institutional perspective. Doesn't mean that we don't get in on the short term trade and you don't take lower time frame trades, but once you understand that you've got to be a bit more patient with your trading, then it makes a lot more sense. So and also as well, to add to that quickly, is that, let's say for example, we're looking at long on the euro dollar, right? Because I think that the euro is a better trade, is a stronger pair than, or stronger currency than the US dollar, right? And the Federal Reserve, the ECB, are definitely not cutting rates, whereas there's a possibility that the Federal Reserve will continue cutting, right? So I think that this is a bit of a bargain area. Now, who knows where price will reverse, right? What we're trying to do ultimately is consistently pick where prices are going to reverse, right? But of course we're going to get that wrong. Now let's say for example we enter into a trade, but prices go against us. Fine, that's fine, as long as nothing has changed, as long as there's no fundamental drivers that have changed while we're in that trade and prices continue to move to the downside. All that's telling us really is that just the market hasn't seen that price where we entered as enough of a bargain to reverse price, right? So that price was reverse. So if we lose a trade, that's fine. And the fundamentals haven't changed, then I'm looking for a trade which is going to be, or take another position lower, right? Because maybe down here might be where the market is looking at thinking or considering that this is more of the bargain price, right? So that's all I'm doing. And then they say don't catch a falling knife, but if you understand that fundamentals are the main driver over the medium to long term, and the short term, of course, you've got algorithms, you've got market making, liquidity hunting, etc., all of that going on in the very short term. But if you understand that over the long term and the medium to long term, that something, an asset class, can't be cheap or expensive forever, or undervalued or overvalued forever, then it's just a case of looking to buy at lows, and sometimes just understanding that you may have to enter into a trade, maybe once, twice, maybe even three times, right? Depending on, your how you enter, etc. But I'll get into all of that a bit later. So that's really where how I trade overall. And of course, we use technical strategies like the supply and demand zones. I use the RSI, things like trendline breaks as and horizontal support and resistance, including diagonal trendline breaks, stop hunts and CPR setups as well, in alignment with currency index confluence. Now, for me, the currency index is very, very important, really, really important. Is a key piece. Now, not everyone trades with currency indexes. There are trades that will work without using the currency index, but for me, currency indexes are essential. And again, we'll get into that a little bit later. And that really, looking at currency indexes is really just identifying overall currency premiums and discounts, whether a currency is on the cheap side, expensive, or fair value. And in terms of risk management, I would say while you're learning, some people might be a bit more confident, but never, I wouldn't risk any more than 1%, probably preferably less than that. And then also as well, divide that up into multiple positions. Many of you do know that I try to enter into a few positions when trading, and yeah, that's really the way that I go about things. And again, just to reiterate, if you lose a trade but fundamental sentiments have and fundamental or the risk sentiment hasn't changed, just go again and again until you do win. And when you're looking to hold a trade, when you're looking to win, don't for example, let's say, I don't know, you get involved in a trade, right? And let's say, for example, you've lost twice, and let's say that represents 2% of your account. You get in on a third trade and it starts to move in your direction. You know, if it's a trade where you think prices should go a lot higher, and you should really be taking those types of trades anyway. Don't take trades that you don't think are going to move a lot of pips, and there's not a strong divergence, right? You're assuming that the one trade that you're in is going to make up for the trades that you've lost plus more, right? So don't enter into a trade, lose a trade, and then your next winning trade just cover the losses, and then because you don't want to lose the profit that you're in, and you just want to get back to break even. No, just continue to kind of hold the trade, trail the stop up, get yourself to a break even position. But the main thing is to try and hold that trade, trail your stop up for as long as possible, or where it makes sense, logical sense, to kind of maybe take profit as well. So you can take profit in areas where the risk reward is really good. You don't necessarily have to hold the trade forever, because of course overnight swaps can kind of eat into your profit as well. But if, let's say, for example, this, you've got in down here and this represents a nice 3, 4, 5 to 1 trade, and let's say, for example, you've lost 2 trades previous, excellent, cool. If this represents a 4 to 1 and you win that trade, it covers your losses, plus it gives you an extra 2R on top, right? So that's really what you're looking towards in the approach. So ultimately, as well, take your time. You're with me for a minimum of 3 months, a quarter. It does take time. There is going to be a learning curve. Everyone's learning curve is different. Some people might take to this like a duck to water. Some people, will maybe find it a bit challenging, right? And especially because, if you've got, a job, and, you've got family commitments, etc., right? Maybe a bit time poor in that sense. It can take a little bit more time, but if you work at it, eventually you'll start to see the fundamental patterns. You'll start to recognize how to kind of ignore the noise, because there's going to be a lot of noise, but I'm here to help you to filter all that noise and give you the direction that you need, and that I need as well, right? Because I'm showing you how I'm trading as well. And And yeah, so just take your time and give yourself a bit of grace, and just know that this is a high level skill which can take some people years to develop, most people anyway, you know what I mean, to really kind of get the hang of it and be profitable. So it took me a few years. So yeah, that's what I would say in terms of trading 180, right? So getting into the risk sentiment and looking at really the markets. And so it's important that we look at risk sentiment, because risk sentiment would be a main factor, right? A main driver of, oh, you're welcome, Brian, no worries, will be a main driver of where money flows into and out of overall, right? So um whether the market is looking for safe haven plays, right, or whether they're looking for a yield return. So if the market is looking for, if risk is on and they're looking for more of a yield return, then that's basically saying that they're looking for rate differentials, meaning that they're looking to either, the carry trade, where, investors will buy a higher yielding currency over a lower one, or they're looking for differences in rate cuts, hikes, and holds, right? So that's basically the fundamental side of things. If risk is off and traders are looking for more of a safe haven play, then all that kind of goes out of the window. All the fundamental stuff and yield return goes out of the window. It's more about capital preservation. And so, to preserve capital, traders will tend to go into safe haven, traditional safe haven currencies, which would be like the Swiss franc, the Japanese yen. Although the Japanese yen over the last maybe 3-4 years has not really acted like a safe haven currency at all. And of course, the US dollar, depending on what the risk event is, right? And so one of the things, one of the asset classes we look towards, or an indicator, I guess, would be the VIX, right? Volatility index. And the volatility index is, it has two purposes to measure kind of volatility of the market, as well as risk sentiment. And 20 is seen as a line in the sand for risk on and risk off. The further we move above risk, 20 is more risk off, and then the further we move below 20 is seen as a bit more risk on. And that is kind of confirmed as well by the S&P, the stock market, the biggest stock market in the world, I think. It should be anyway. I'm not sure about the Chinese stock market or whatever, but yeah, the S&P is also a risk asset. So when risk is off, then you're likely to see the investors kind of take profit on stocks, and you'll see the S&P move to the downside. And when I say move to the downside, not just any move, it would normally be a move like this, something where you get that kind of move, a sharp move, a sharp sell-off over a day or two or three. And you can see that kind of coincides. If you see that October the 10th, right, that sharp sell-off there, was, you can see where Friday, October the 10th on the VIX as well, went to the upside, right? So that was definitely more of a risk off day. I can't remember what happened that day or that time. But yeah, it coincides with that. So in terms of risk on, if we see volatility, but the market is still, the trend is maintained, price is still moving higher, then of course it just means that we're getting a bit of volatility, but we're still in that risk on environment. If we get, risk off, one of the things we definitely have to also do is understand what the theme is from the main pages. So look towards Bloomberg. So you look at, Wall Street buys the dip in stocks after AI rout. So I think yesterday and the day before, the beginning of the week, there was this so-called risk off sentiment building in the market. One of the reason for it was, I think, that the market was thinking that AI stocks were overpriced, or the stock market was overpriced. And in my opinion, what I think happens, and what I've noticed, is that the market will use a certain narrative to kind of justify sell-offs, right? But then we'll end up just changing the narrative and say, all right, then now we're buying, right? We need to buy for cheaper, because that's what it's all about. It's about buying. It's about valuation, right? If something is overvalued, undervalued, something is premium, or you're buying it at discount. And so Forex is no different, right? But in terms of market sentiment, sometimes you can get well, you will say sometimes, but you will get market narratives that will appear. Now, for me, depending on the market narrative will depend on whether you want to be maybe long-term short, or just, maybe try and take advantage of short-term short, right? And maybe take advantage of a bit of short-term sentiment. But ultimately, you're looking for major themes in the market. So you go to Bloomberg, you go to the front pages of Financial Times. You don't have to subscribe to these markets, by the way. You don't have to subscribe to Bloomberg to be able to view. We shouldn't anyway. I'm not subscribed, for example, to the Financial Times. I used to be, but I'm not anymore. Not because it's bad, but just because I get pretty much everything you need from Bloomberg, and it would be kind of like doubling up if I was to buy the Financial Times. They pretty much do the same stories and articles. But yeah, so you go to Bloomberg and you see the main theme is Wall Street buys the dip in stocks after AI rout, and then you go to the Financial Times, and they basically are saying the same thing, right? Wall Street steadies after tech-driven sell-off, and then you look around and you just go to maybe somewhere like Reuters as well, and Reuters has futuristic quantum computing stocks take speculators on roller coaster ride, and then they've got their thing there in terms of opinion split over AI bubble after billions invested. Don't panic yet, investors say as high-flying AI stocks tumble, but ultimately, oh, need that. By the way, that'd be useful for later for Canada. Um, Canada's October services PMI shows first expansion in sector this year, so that's positive for the Canadian dollar. So if you are a buyer of the CAD, of course you want to look for things like that. Anyways, um, so yeah, the main theme, if you have a main theme in the markets, then that's probably what's going to be driving the markets. If you come on Bloomberg, Financial Times, and Reuters, and there's all different stories, then there's basically just no theme, and you can just assume that the market is going to be more risk on, as long as, of course, everything lines up. And again, gold, a barometer of risk sentiment, but also as well how the dollar is doing, dollar strength and weakness. We've had this, pullback. It looks pretty, like a like gold is pulling back, but when you zoom out, for example, the 6 month area, you can see pretty much gold has been. This is just a pullback over the last 6 month time horizon, right? So I wouldn't say necessarily, gold now, risk is definitely is off or on. I would just say sometimes it can be have confluence with risk sentiment, but again, that would depend on what's happening with the main pages. And in terms of treasury yields, as I've explained before, treasury yields can be used as a bit more risk off as well. But again, I'll get into that maybe another day, because I find I'm already half an hour into this, and I don't necessarily want to make this maybe a 2.5 hour webinar, right? So, but just know that bond yields also respond to risk sentiment in the same way it does with with actually interest rates going higher as well. But again, I'll get into that maybe another day, or I'll try and find a video and a video that I've done previously, and I'll post that to kind of explain why that happens. Anyways, so that's that. Now, looking at the US dollar. So the US dollar, at the moment, I think it is. I still have a sell bias. Now, didn't really manage to kind of update this, but we'll look at the up to date FedWatch tool and look for the probabilities. You can start to see now. In fact, you're seeing after the ADP report maybe about an hour ago, the chances of a cut are now 64.5%. So 64% of a cut. Now, those are still, in my opinion, those are still, I think, fairly good odds of a cut, right? Because if you had a coin and you knew that it was maybe 64% chance of getting heads rather than tails, you would bet on heads. So 64% chance of probability of a rate cut for me is still for me doesn't change my bias, although we did have the ADP data kind of come out and really kind of support the where is it now? Sorry, I should have had it lined up. ADP, where are we? support a stronger dollar. Where is it now? Yeah, so here we are. So basically, labor market snapshot, October ADP report. So private payrolls came in at 42,000 jobs, and it was above expectations, right? So 30,000 was forecasted and revised from a minus 29,000 in September. So modest growth, signs of stabilization, but still soft demand overall. Now, one of the things about ADP is that it's not the greatest when it comes to its track record. So it says here, and this was from July this year. It says ADP doesn't have a great track record of anticipating the government's non-farm payroll report, which is really what we're looking for. And of course, we don't have the non-farms because of the government shutdown. And it says, but it adds to the data showing labor market resilience. So ADP doesn't have the greatest track record. And if you've been trading long enough and looking at ADP, you pretty much know that a lot of people tend to ignore ADP, but because it's the only data we've got to go on, it's taken a bit of, a bit more significance. So it says here, small businesses job losses for the fifth time in 6 months, and really small businesses, are the main employers. Small to medium sized enterprises, SMEs, are the main. I think they hire the most people overall. But anyways, the main driver though was of course large companies. Now, again, the outlook for the ADP, it says here, moderate job growth supports the case for wait and see approach by the Fed at the December 10th meeting. However, if official jobs data when released confirm continued weakness, it could tilt the Fed towards a 25 basis point cut, as markets are currently pricing in a 71% chance. Well, now it's actually gone down to 64% recently over the past hour. Chance of a rate cut, right? So that's pretty much what is happening with the dollar. But overall, it's saying that, of course, the dollar has risen to its highest level since August. This move reflects renewed upward momentum, primarily due to hawkish Fed commentary and market reassessment of rate cut expectations, right? It's not due to Elliott wave. It's not due to some outside engulfing candle or some pin bar at a level of support or demand, right? It's not that. It's the market moves based on interest rate expectations over the medium to long term, right? Fed Chair Powell, a December rate cut is not a foregone conclusion, pushing back against previously near fully priced expectations. The US dollar remains firm for now, supported by hawkish Fed signaling and rising yields, but the outlook is clouded by political uncertainty, internal Fed division, and lingering data gaps. A pause in December is more likely than a cut if shutdown disruptions persist. So that's really what's driving, I guess, the dollar moving to the upside, because the Fed are probably it says here they're unlikely to cut the longer the shutdown goes on. It says, but the market remains undecided, and any surprise on inflation or jobs could quickly shift the balance. So there's a lot of uncertainty around the dollar at the moment, right? And one of the things that, it's a small thing, but a big thing at the end of the day, is that when deciding on trading and choosing a currency to trade, you really want to try and go with the clearer options, right? Now, of course, the dollar is the main currency, the biggest currency in the world, most traded currency in the world, right? But that doesn't necessarily mean that you should be trading it week in, week out. If it feels uncertain to you, or doesn't feel any, and applies to every currency, if you don't feel that there's a strong enough direction to buy or sell, then just don't. Or you can basically just enter into a smaller position than usual, is what I would also advise. Don't feel like you have to take a trade on the dollar if it's not clear, right? So, because I don't want you to be confused. And if you are confused, use that as a sign, right, that you shouldn't necessarily be trading that currency pair if you're undecided as to which way it's likely to go. So, but Personally, of course, I can only just talk about what I'm doing personally. My personal bias is I still think that the dollar is on the expensive side, right? Data today, yes, has supported it, right? And we're at the top of this. This is the dollar index. We are at this quite a significant level when you look at it historically. It has been traded. The support and resistance. I'll zoom in a little bit. So you've got support there, resistance there, level of support. Right. Zoom back a bit. It's been traded. Resistance there, support there, support there as well, resistance, and this is going back to 2023, right? So it is an area that has been traded significantly recently as well, I mean, this year. So I do think that the dollar may have reached its high. I'm not saying it's going to reverse here. It could go a little higher before it comes lower. um but I think now is probably a nice time if you are looking for shorts, which I am, to look for short trades. Right, nothing goes up forever, especially when you see what 1, 2, 3, 4, 5, 6 bullish days, and it could continue to go higher. But usually, whenever you see something like 1, 2, 3, 4, 5, 6 bullish days into a level, or bearish days into a level, then you normally get some sort of pullback, right? Same thing here, 1, 2, 3, 4, and then you got maybe a little bit of a reversal there. So you got maybe 7 days, and then you got one bullish day out of that, and eventually you get moves, that moves to the upside or downside, right? But ultimately, if you get a move like that into a level, I like that in terms of looking for a reversal, because ultimately you're going to have some faith in the fundamentals, right? And like as I said, I think the market pricing is still in favor of a rate cut so far. So hopefully, of course, that continues. This can change if data comes out, and let's say the government shutdown comes out, is over, and then data supports a rate hold. Then of course I will change my bias on the dollar, and I will go long. Yeah, that's really the key. I'm not married to one position. But in terms of technicals and fundamentals, I think you can look for longs and shorts. If you're looking for a long, then you definitely have to wait for a pullback into a, a demand zone there, or you could look for a level right here and prices pull back down, and then you'd need the RSI to be below the 30 as confluence, right? So that's what you're looking for on that. But ultimately, that's, like I said, I think for now, I think the shorts are in. But again, we'll get into some of the setups a bit later, and exactly how to kind of time a short on the dollar if you are looking for shorts on a dollar, and what kind of pair to trade it against, right? So dollar for me, you can go long and short, but I still have a short bias. The euro, I've got a bit more of a longer bias on the euro, although I understand why you would look for sells. So bias, you would look for sells. It says here inflation is easing but still above the target. President Christine Lagarde said policy is in a good place, meaning the ECB believes its stance is appropriately restrictive to bring inflation sustainably to target, meaning that they're looking to hold, right? The ECB is waiting for clearer disinflation evidence. Waiting for clearer disinflation evidence before cutting rates. Inflation is close to target, but not convincingly stably there yet, or convincingly stable there yet. Growth is soft but not collapsing. The ECB is cautious, keeping policy tight enough to anchor inflation expectations while monitoring how trade disruptions and global shifts play out. So overall, the the European Central Bank are looking to potentially hold rates for now, and so again they're content with the valuation of the euro. So when we go to now the euro index, it's a case of whether you want to be a buyer or seller. I think we're likely to probably stay within this. It looks like we're within this kind of this auction, this range anyway. But we could end up coming down to maybe this area here, this demand zone as well. But ultimately, I think any pullbacks on the euro should be probably buying opportunities if it pulls back even deeper down to this area of demand. I think that's going to be nice. But either way, I think buys on the euro, unless of course data comes out and shows otherwise. Is basically what I'm looking for. The Japanese yen. So many of you last week and the week before would have known that you know, started positioning long the Japanese yen, and that New Zealand yen trade worked out quite nicely. Unfortunately, I only managed to get in on one position rather than a couple of positions, but profitable trade nonetheless. Again, we'll go over that a bit later. But the Japanese yen. It says here that Tokyo inflation accelerates. Tokyo CPI often serves as a leading indicator for national inflation. The uptick suggests nationwide inflation may stay above the Bank of Japan's 2% target longer than expected. Governor Kazuo Ueda continues to argue that underlying inflation momentum is not yet sustainable enough for rapid tightening. Still tightening, but not rapid tightening. The central bank is likely to raise rates gradually, if at all, preferring caution amid global trade risks. Japanese officials, including Mimura and Katayama, are clearly uncomfortable with the pace and nature of yen depreciation. While intervention isn't imminent, the risk is rising if the dollar yen breaks towards the 155 to 160 or if volatility surges. The yen's recent moves are no longer fully justified by rate differentials, basically the fundamentals, right? Forcing the risk of either verbal jawboning. So verbal jawboning is when someone from the Ministry of Finance or the Bank of Japan will come out and start to say that they're unhappy with the valuation of the currency, which basically is signaling that they could do something to stop the devaluation or appreciation, in this case of the Swiss National Bank. But with the Japanese yen, it would be more about the depreciation of the currency. And so, this is why, and, I don't need to keep repeating myself, but it's, moves in large moves in the Forex market are really driven by central banks, right? They're the ones that are controlling the valuation over the medium to long term. And so what they'll do is they'll actually step in to try to depreciate the currency or appreciate the currency, because ultimately, if the currency devalues too much, what it's really saying is that inflation is going to be rising too much. And in order to counter inflation, which is basically the depreciation of a currency, they have to either hike rates, which is basically what the Bank of Japan are looking to do, or they may, if they don't want to do that just yet, they may intervene and look to again, intervention basically to try to strengthen their currency without having to necessarily having to move rates. And so how that kind of looks on the yen index, right, is that the yen, right? So if you see that inflation is correlated to the price of the yen, right? So what you'll see is how the yen has been devaluing, right? It's been devaluing. This has been, years in the making, right? This has been like 2025, 24, 23, 22. And if you actually go and look at, let's go to trading economics. Let's go to, let me zoom out a bit. Let's go to, indicators. Let's go to inflation rate. Let's go to Japan. Yeah, and let's zoom out a bit. You'll see that inflation, which is the devaluation of a currency, has been moving higher since 2021, right? See that move there, and it's kind of sustainably been around that 4% at the beginning of 2025 and kind of remained above their 2% target. That's not, coincidence when you look at from 2021, the devaluation of the currency, right? Look at that and that, right? So ultimately what the central bank want yeah, is to reach their 2% target. So they don't need the yen to get any weaker, right? If the yen continues to get weaker, it means that inflation, won't reach their 2% target. And in fact, it will move further away. It'll move towards the 4, towards the 5, etc. Therefore, they're going to step in, right? They're going to try to step in and intervene and hike rates to stop prices moving to the downside. Yeah, that's what this is all about. So, and that's why the Ministry of Finance, or the it says here Japanese officials, I should say, Minamura and Katayama, are clearly uncomfortable with the pace and nature of the yen depreciation. The yen depreciation. Remember, this is the equally weighted index. This is the yen equally weighted against the dollar, the euro, the pound, the CAD, the Australian dollar, the New Zealand dollar, and the Swiss franc, right? So this is what the yen has been doing against all of those currencies over the years, right? So they're unhappy with the depreciation of that currency. So with that being said, of course, there is an opportunity to buy. Bit on the riskier side, of course, everything is a risk, everything is a gamble, but I do think that the yen on pullbacks, I think, should be actually a decent buy and continue to be a buy, because you've got the invisible hand of the central banks, right, looking to potentially, prevent this from going lower. Now, again, as many of you who have been with me for a while know that the yen is, I think, who was it? I think it was Daniel who said it best last week. Never underestimate the Japanese yen's the ability for the Japanese yen to depreciate even more, right? Because trying to pick a low is going to be very difficult, right? But at the end of the day, one of the things to watch is, and as it said, I think it says here on the dollar, for the dollar yen, where is it now? There was some oh, this is the wrong one. Sorry, wrong channel. It was saying here about the dollar yen. That's it. Sorry, the 155 to 160 area. So that is where, if you're looking at currencies and you're looking at the yen, the dollar yen, right? At the moment, it's at 154. So between 155, right? Between this area here. Oh, in fact, I'll just do it like this. 160 is here. 155 is here. So between that area there is the intervention zone. So the higher this moves into this zone, is the more likely there is to be the potential for an intervention. So there's about 500 pips worth of movement before they're looking to intervene. So they're starting already this week. They did start their verbal intervention, and then they'll actually have to intervene if prices do move to the upside, continue moving to the upside. Anyways, but the yen, I think you can look for reasons to buy and sell. So political uncertainty will make it a sell, and buy the rumor on rate hikes and intervention can make it a buy. So it's a tricky one. It's a very tricky one. Who's that? It says John. No worries, John. No worries at all. We'll watch the recording later today. Have a great day. Yeah. Looking forward to seeing the pair outlook. Yeah, wondering what my watch. Okay. Yeah. I know. Yeah. It probably does, John. You know what I mean? Your pair's probably are the same as mine. But yeah, I'll speak to you in a bit though. Yeah. So yeah, so that's really where I am with the Japanese yen. Look for buys, look for sells, as well as sells. I'm still in that New Zealand yen trade, but I might take a bit of profit. In fact, I've taken profit on that. It's a profitable trade, but I might just take the full profit and see what happens on with the rest of it. And I can try and get in on the pullback, but I'll get into that a bit later. The British pound. So the British pound for me is on the sell side. So I do have a sell bias. I think the latest data is, one second, central bank rates. I think the latest data is for the Bank of England. Yeah, there's a 60% chance of a hold, right here, expected action. So in fact, it does look like that should be updated to a 65, so 60% chance of a hold. And it says here the Office of Budget Responsibility is poised to lower its estimates for UK productivity by 0.3 percentage points, which could hand Chancellor Rachel Reeves a hit of as much as 20 billion. So the big thing in the UK at the moment is our budget coming up on, I think, the 26th of November, and that will really affect the economy, going forward for the foreseeable future. And so it says here the OBR have lowered they're poised to lower estimates. Basically, they're saying that there's the potential for the budget to actually contract the economy, which would basically not be great for the pound. Anyways, Rachel Reeves faces having a budgetary hold as much as 35 billion to restore her slim 9.9 billion margin against her key fiscal target, and may need to find at least 50 billion to shore up the finances. The situation may lead to tax rises, which Reeves, having paved the way for such measures in a recent speech and declining to reiterate Labour's promise not to raise certain taxes. Ben Perks, managing director of Orchard Financial Advisors, says Reeves' speech this morning, it was like yesterday morning, I was listening to it, was reminiscent of a safety briefing before a bungee jump. She basically told the nation in advance to strap in and hope for the best. So that doesn't sound too great, does it? Goldman Sachs says sterling weakness is linked to a decline in longer-dated UK bond yields, which analysts say is consistent with a further reduction in UK fiscal risk premium and is a slight positive for the currency. It means the market doesn't see an adverse negative reaction to the budget. The most famous example being the response to Liz Truss mini budget. But on the other hand, incoming data, including materially softer food inflation data in last week's BRC October report, has continued to continue to point to room for earlier and deeper bank rate cuts than the market is pricing. So that's really a key, right? Because if the market starts to price in more rate cuts, it will mean that the pound should look to sell off, right? It should look to sell off. Actually, matter of fact, not that one. There we go. Yeah, the pound will likely sell off as the market values the pound lower due to the valuation of the pound and interest rates. So it should continue to move to the downside, right? Whether it moves higher in the short term, who knows? It could, fall off here, or it could move to the upside. But it just means that any pullbacks, if you get it, should be really kind of shorting opportunities. That's really my opinion. Sorry, 1 second. Let me go back. Yeah. So the direction really is to the downside for now, unless of course the budget comes out and it's fantastic and the market thinks that it will everything will be all lovely. So but in my opinion, I think the budget isn't going to be great for the UK economy. Therefore, I think they might have to end up pricing in more potentially more cuts to support the UK economy. So that's where I am with the pound, the Canadian dollar. So the CAD, there was at the moment, I think there's a 95% chance of a hold. 95% chance of a hold. Probability at a rate hold at the upcoming meeting. And it says here a pause in the Bank of Canada rate cut signaling a more hawkish stance. Bank of Canada has indicated limited near-term room for further easing. This follows stronger than expected inflation data and solid job market conditions. The IMF supports Canada's fiscal stimulus, noting its appropriateness in very testing times. This adds credibility to the government's plan to and reduces fears of fiscal irresponsibility. Larger fiscal stimulus equals more growth support, which reduces pressure on the Bank of Canada to cut. If growth picks up and inflation remains sticky, CAD could strengthen further, especially against low-yielding currencies like the Swiss and the yen, Swiss franc and the yen. However, deficit-driven loonie strength is conditional on growth outcomes. Failure to boost productivity or private investment could reverse optimism, and that's really one of the you had this as well, which was Canada's October services PMI shows first expansion in the sector this year, which is actually quite positive, right? So Canada's services economy expanded, right, for the first time. That's a great sign for the economy. First time in 11 months as businesses showed signs of adjusting to economic uncertainty. S&P Global's Canada services PMI's data showed on Wednesday. So yeah, that's a really good sign or a positive sign or a contributing factor to why you would want to be a buyer. So one of the questions is it often that the euro and the pound don't go hand in hand in one direction? Sorry if it's not the right time to ask questions. No. So the euro, no, so it's not it's not often. No. So it really just depends. They're not correlated like that in terms of the central bank policies. Yes, we are obviously close, but you got to think about it from the perspective of Europe is made up of what is it, 26, 27 countries, something like that, whereas the UK is only one. So you've got a vast dynamic when it comes to the ECB has got a much harder job managing 27 countries in terms of trying to get inflation down overall and getting the right interest rates um and managing their economy and their eurozone than the Bank of England does managing one country, right? So no, they're not correlated in a sense of central banks. The European Central Bank will cut, therefore the Bank of England will cut, and vice versa. But they are correlated, maybe overall. So maybe that world inflation. So what you'll notice is actually that whenever the, the main central banks, or the central banks, I guess, in the West, um, normally are on the same cycle. So they normally, if one central bank is cutting rates or inflation is rising, it's normally rising everywhere, and that's probably just due to things like well, say things like, but more due to kind of globalization. China's obviously different. They manage their economy a lot differently, and the People's Bank of China manage. They kind of have um, a fixed rate kind of thing, whereas we kind of allow inflation to kind of do what it does, but in terms of the valuation and the valuation of our currency. But um, I would say it's more about leading and lagging, right? Currencies in terms of inflation and interest rates. And so, although overall you may have central banks maybe going in the same direction, it will be about who goes first and who lags behind, or who leads and who lags behind. And in fact, I do have a video on that. I think it was an old webinar I did a few years ago, which can help with that. But in terms of direct correlation, in terms of like the euro and the European Central Bank and the Bank of England, one follows the other. It's not, the correlation isn't because of they're geographically close. It's more about global inflation, which kind of affects everybody. So, for example, over this last year, you've pretty much had all central banks cutting to varying degrees, apart from Japan and the Bank of Japan. So, I would say overall, the answer would be no if you're looking at them both in isolation. But yes, in terms of global um uh, uh central banks looking to fight inflation overall, then they all tend to, I say all, but the West anyway, tend to move in the same direction. Hopefully that's a bit clearer. Yeah, makes perfect sense now. Thanks for the explanation. Yeah, no worries. Right. So where am I? To Canada, I think there is positives, and again, if you've been with me the last few weeks, I've kind of said that I've been creeping into the buying the Canadian dollar. I bought it against the pound, and that trade worked out quite nicely a few weeks ago as well. So I think the CAD actually can be a decent buy. So I'm going to keep it as a buy. I think it needs to pull back though. It does need to pull back a little bit before looking. Actually, in fact, it's all right. I think it's okay. I mean, it's not necessarily the cheapest, although it's below the 30 on the RSI, and I think you've got a level of support and resistance going down to the monthly. Yeah, actually, it's still on a bit on the high side. I don't really like if you're looking at that being a monthly high, monthly low, and then you're looking at where fair value is. Fair value is at 1968 around there. You're buying really on the high side for the CAD. I would rather it come down to around, somewhere around here at least, bare minimum, somewhere closer to fair value on that monthly. So I don't, although it's an indication of cheap on the RSI, on the daily, I probably prefer it to go a bit lower. If it goes higher, so be it. But I'd rather wait for a deeper pullback to get involved in the trade. So I am long, but I want to. I want to buy the CAD at a better price. Where are we now? So the Australian dollar. So the Australian dollar, I think now is definitely a buy. I said there's a short-term sell. I haven't updated that. Definitely a buy, and that was because of the recent data. I think it was inflation data. Sorry, inflation data came out higher than forecasted, and it says here that Bullock emphasized no bias towards hikes or cuts. So basically they're looking to hold rates, right? We may be a little bit restrictive, we may not be, she said. Restrictive meaning maybe a bit more hawkish. She said RBA didn't even consider a rate cut this meeting. The RBA is in wait and see mode. Core inflation is now expected to exceed 3% through mid 2026. Surprising Q3 inflation surge raised questions about further easing, with sticky inflation, resilient demand, and only modest labor softening. Further cuts are unlikely near term unless there is a clear downturn in economic conditions or inflation drops faster than expected. So again, looking at the latest data for the RBA, it does look like there's an 85% chance of a hold. It says neutral dovish. Not too sure whether you could kind of look at that as being dovish. I think probably more neutral, but overall, 85% chance of a hold is definitely, the Australian dollar would be more of a buy, right? In terms of, when you're looking at who's holding and who's cutting, definitely the Australian dollar is one of the better currencies. So I've got a buy bias. When you're looking at the pullback, needed a bit more of a pullback. We do have, again, the Australian dollar index has pulled back, and it's on the daily. But when you're looking at this from a monthly perspective, monthly time horizon, I don't want to buy at these highs. I really don't. There was an opportunity to buy. I think it was earlier today, but I think that opportunity is probably gone now. I want to see prices pull back. Definitely see prices pull back to at least fair value or a cheaper area before looking at buying the Australian dollar. But overall, my bias is to look for buys on pullbacks, no matter how long that takes. So buy bias. The New Zealand dollar, on the other hand, had some data come out, and it wasn't great for the New Zealand dollar. It looks like there. It says here 93% chance of a cut, and they're strongly dovish, right? So a 93% chance of a cut, not by 60 basis points, about, was it 27? It was. And it says here, highest unemployment rate since 2016. That was it. The unemployment rate came in a bit higher last night. Annual employment fell to 0.6, much weaker than expected. Wage growth slowed for the 10th consecutive quarter, 300 basis points of rate cuts since August 2024, with another 25 basis point cut expected November 26th, bringing the OCR to 2.25%. The data matched RBNZ's projections, supporting a continuation of easing. RBNZ has acknowledged the need for more support if employment doesn't pick up. RBNZ set to cut again, dovish bias. And I think the New Zealand dollar is a great example, really, of, we've been short on that New Zealand dollar for a while now. I think probably since, maybe about June, July, when they started cutting around these times, we were looking for short trades, and we've been short, just had that short bias on the New Zealand dollar for, basically since around July. So the last maybe about 4 months or so. And data has just basically proved and shown that that's basically the case, right? And so if you are continuing to look for sells on the New Zealand dollar, then really you're waiting for pullback. Pullbacks do happen. If you missed out on this pullback here, I got involved in that New Zealand yen trade, right? The New Zealand yen set up really nicely around here. The New Zealand dollar was expensive. The Japanese yen was a bargain. And so that trade ended up working out short. So really, again, a pullback up into somewhere around this zone, if we can get it, be another opportunity to look for a short trade on the New Zealand dollar, as long as, again, the fundamentals don't change when prices get up there. And then the Swiss franc. So the Swiss franc, I'm probably going to have a little bit of a sell bias now. And I said in the group this week, I think it was Monday morning, inflation came out lower than forecasted, which is kind of like opposite to the Bank of Japan. The Bank of Japan have an inflation problem. The Swiss National Bank have a deflation problem. Now, deflation is when the currency actually is too expensive. Remember that you've got, if 2%, right, let me draw this out. So let's say, for example, the central bank's target is 2%. Yeah, that's the 2% line. The higher inflation goes is basically central banks have to hike rates. The lower prices go, right, and that's basically seen as devaluation. 2% is devaluation anyway, right? But the higher it goes is basically, it's more of a devaluation. And in fact, if it goes below 2%, this becomes appreciation, right? And so what you have is a situation where, it says here that headline CPI is at 0.1%, close to 0.1%. Remember, central banks have to get inflation back to that 2% target, to this line here. So in order for them to stop appreciation of the currency, guess what they have to do? They have to cut rates. Cutting rates is actually a way to counter appreciation, because cutting rates is devaluation of a currency to try and get inflation back to their 2% target. So they have an appreciation problem. It's too expensive. So, core inflation is at 0.5%. These readings are far below, right? Far below the S&B's 2% target, increasing disinflationary pressures and raising questions about whether further easing might be needed. Cutting. Yeah. The S&B is in a difficult position. A strong franc is acting as a deflationary anchor. Rate cuts would weaken the currency, but risk financial stability. If inflation stays near zero in coming months, a sub-zero rate cut becomes increasingly likely. So at the moment, interest rates for the Swiss franc, or Swiss National Bank, are at zero. Central banks really don't want to go into the negative. They don't want to go into negative, 0.1 or 0.25%. They really don't. And so what they're likely to do is, first, is probably either intervene in the market to try to prevent appreciation. As a last resort, it looks like they are probably looking to potentially price in. Now, I have seen the probabilities change. So I think it was on Monday when I did the rate updates. I think it was about 90% that they were looking to hold rates, right? But since the inflation data came out, now it's gone down to 70% in terms of a hold. So which means there's a 30% chance of a cut, right? So there, right? Because of that data. So therefore, on the Monday, I did put out a message to everyone in the discussion room to basically say that I'm looking to now go short on the Swiss franc on pullbacks, because the Swiss franc, if it pulls back, remember, they don't want the currency to appreciate. They don't need it to go higher, because that's going to cause more deflation. And again, we can go back and we can look at inflation rate for Switzerland. And we can go back the last, say, 5 years. Now, we can look at, say, from 2022, right, all the way here. You can see prices are pretty much, or inflation has gone to the downside, right? It's gone from 3.6%, right, here, all the way down to 0. So when we look at here, 2023, we can see from about here, 2023, look at that. Prices have gone to the upside. Inflation has gone to the downside from 2022, 2023. Yeah. So they don't need this to go any higher. So what they'll do is they will intervene. Yeah. They will look to intervene in the market. And one sec. Yeah, they will look to intervene in the market, because if prices continue moving higher, then they're going to try to stop this and prevent this from going any higher. Oh, I did that for. Sorry. Trying to make the point. Yeah, they'll prevent this from going any higher. They don't want it here. So this is where they're starting to intervene. So any pullbacks on that Swiss franc, shorting opportunities. That is, as long as, of course, risk is more on than off. Because in a risk off environment, if money starts piling into the Swiss franc, it's going to be hard for the Swiss franc to cheapen, to devalue, because money's, there's going to be a lot of demand for the Swiss franc, which then, makes it a bit difficult for the Swiss National Bank, but ultimately they don't want it to go higher. So you've got that, that wind in your sails when it comes to looking for any kind of short trades if prices move to the upside. So Swiss franc, my bias is to look for sells, right? That's where I am. So now it becomes a lot easier to determine which currency you want to be a buyer and a seller of, right? So let's go through this. So anyone, you probably guys obviously remember what I am, right? So I'm going to be more short on the dollar, but I understand why in the short term, with the lack of data, you may want to be a buyer, but my bias is definitely more on the sell side. Yeah, that's where I am with the United States. The United Kingdom, definitely a sell. Switzerland, definitely a sell. New Zealand, definitely a sell. Bank of Japan, again, similar to the United States, I can understand why you'd want to be a seller or a buyer, so you can buy low and sell highs. The Euro area, when you can, and again, in comparison, you're looking at who's the dog with the least fleas, right? Who's the best of the worst. And so for me, the Euro area, when we look around and they're looking to hold rates, of course, you want to be probably more of a buyer, right? The Canadian dollar, I can see that being more of a buy. Also as well, I don't think I've necessarily mentioned it, but you've got the fiscal policies, fiscal budget for the Canadian government. I think it was yesterday. I haven't even seen any news on it, but that should be supportive or could be supportive for the Canadian dollar. And if it is, that should be more of a buy. So I'm a bit more bullish on the Canadian dollar for now. Although there is, kind of maybe some sort of risk sentiment kind of weighing against it, but I think the Canadian dollar is decent. Also check oil out as well, whatever's going in the oil world, but fundamentally, I think the Canadian dollar should be supported on buys, and the Australian dollar is more of a buy, right? And this is providing that risk is remains more on than off. Of course, if risk goes off, then money will flood into the Swiss franc, probably the yen, and more likely the United States, right? And then all bets are kind of off in the short term. But what risk off does, right, is that it will, if let's say for example you want to be a buyer, or you want to be we want to be sellers of the Swiss franc, yeah, and let's say for example there's a risk off sentiment or some sort of event, yeah, that causes the Swiss franc to go higher. What does that do? That allows us to be able to short the Swiss franc into a level, because once that risk off event gets sorted, which risk events normally do, when you think about what happened with COVID, when you think about what happened with the Russia-Ukraine war, you think about everything else that's happened in terms of risk off, even the trade war, right, with Donald Trump and China and the rest of the world, that was a major risk off event. That's all been, not say sorted, but you know what I mean? It gets priced in eventually. So then risk off can make things, a currency like the Swiss franc, for example, if you want to get short, push it up to levels where you can get a decent area to go short when risk turns back on. Right, that's what we're looking for. So then, if we know which ones we want to be buyers and sellers of, then it makes sense to now look for the pairs, right? You can look for, to buy the Australian dollar against every sell, right? So the Aussie versus New Zealand dollar, the Aussie versus the Swiss, the Aussie versus the pound. Yeah, those would be like the strongest buy, the kind of the biggest divergences, right? So Aussie, Aussie Swiss, right? Aussie, New Zealand, and then Aussie, pound, or pound Aussie, right? So that is how you choose your pairs, because you've got the biggest divergences in terms of one central bank is holding rates. Definitely the others are looking to, in some way, shape, or form, likely to devalue their currency. Definitely the data, is strong for the New Zealand dollar, cutting rates. The Swiss National Bank, the market's starting to price in the potential for negative rates and intervention. And then the pound, with their risk potential going on with the budget, the OBR downgrading the economy, the Bank of England potentially looking to cut rates even as soon as this week, right? We'll say Wednesday, it should be tomorrow, could be Thursday, could be a surprise cut. If not, cuts might be priced in for December, whereas the Australian dollar, they're not looking to, they're looking to hold until next year. That's what the market thinks. So that makes sense to look for short trades on those currencies. And all you're going to do, and all we do is we do that week in, week out, and we go same thing with Canada. We could look to see, what do we want to buy the Canadian dollar against? What do we want to buy the euro against? What do we want to, if you want to be a buyer of the yen, what do you want to be a buyer against it? Or if you want to be a seller of the yen, what do you want to sell it against? And then you do the same thing. And then that's how you work out the pairs, right? That's how we work out our pairs. And then we go to the pairs tab, and then we look to decide which one we want to trade, right? So New Zealand yen, right? My bias here is for a week short, right? Week short meaning, maybe a smaller than usual position, right? Not necessarily a full position, but maybe a smaller than usual position, or maybe a wider stop, or maybe both, right? But it's not necessarily, you wouldn't necessarily have a tighter stop on it, um, or you wouldn't necessarily go in at a full position. But I did get in on this New Zealand yen. You guys probably saw this from last week. So New Zealand yen, oh, it's pulling back a bit. I might have to, I don't know if I take profit now. Should have taken profit down here. It's pulled back a bit, of course. That's fine. But I do think that we could hopefully end up moving to the downside a bit more of a pullback, and then I'll take profit somewhere around these lows. I'm going to definitely trail my remaining position down as well on the lower time frame, probably maybe the 9 hour. Yeah, I've got to trail it down probably to about here, and then see where that goes as well. So yeah, but I've taken 80% profit off. I've only got 20% on the market, so it's a profitable trade. Now, if you're trying to get involved in this, then I think you'd have to probably wait for prices to probably pull back up to this supply zone. Right here. I would say definitely the top end is a CPR. Why is it a CPR? Because traders would be caught going long, and you can see that actually on the hourly time frame chart. See here that during the London session, traders would have been going long. 8 o'clock, nice breakout candle. So imagine that's all they saw. Imagine that's all you saw, right? Back then, you had no idea. You saw this nice price action here. You saw this nice bullish candles, and you're a breakout trader. Brilliant. Excellent. I want to go long here on the breakout of that level there. Yep. Nice. And then prices start to go against you, right? Now all of a sudden you're in hot water, loss aversion bias kicks in, and now you're underwater. So if prices come anywhere back to here, I'm hoping they don't, but if it comes anywhere here, actually if it does, it doesn't matter anyway, because I'll just get in short again, and then that's it. These guys are going to want to exit their trade. So if they bought here and they're underwater, let's say for example they risked 1% on their trade, now they're down maybe 40% down here. That's a lot of pain, right? Because they don't want to realize the loss. They committed, they got captured. This is the pain, and then the relief. Prices come up here. If they bought, then their order to exit the trade has to be a sell orders. So there's going to be sell orders here. There's going to be sell orders from traders who are just like myself, who were looking to get in short here as well. And then anyone who's bought down here, where they're looking to take profit up at highs. So if they bought here, then they're going to sell around here. So they're going to be lots of sell orders. And then the final icing on the cake is going to be just the fundamentals, the F8, right? If the fundamentals show that the RBNZ are still looking to cut rates, the Bank of Japan are still looking to hike rates, then this is going to be a fantastic area to look for shorts. That's it. That's how it goes. So, one second, let me just move that over here. Yeah, so that's where we are, right? With the New Zealand yen. Looking at the Euro New Zealand, we were talking about this last week, and again, I got into the New Zealand yen, but there was a trade set up on the Euro New Zealand. I didn't want to take too many shorts on the New Zealand, but if you manage to take this, if you go to last week's group call, we were breaking this down. There was an entry around here. I think it was on this 10-hour. Yeah, that was the 10-hour entry right here. Stop loss below there, and look at that. You definitely would have reached your 1-to-1 target. There we are. I think we were just debating whether that was maybe too much pips. I think it was like 150, 160 pips. But as I was saying last week, it's all relative in terms of your upside potential, whether that's 150 or whether that's 50 pips or 30 pips. It's all about your upside potential. And so, yeah, that ended up working out. I'm not too sure whether anyone got involved in that, but yeah, nice trade. The euro should be the buy of the two, and that's basically what happened. Nice trade there. If you are looking for a trade, you have to wait for a pullback now to some degree. Either that, or you're waiting for prices to probably make new highs, and then on the daily time frame for there to be some sort of demand zone. So if that closes bearish, let's say that closes a bit bearish, that creates a demand zone there. Then you're looking for new higher highs to be made, then a pullback into that area there. So I think that's one of the two. So you were looking for that, or you're looking for move higher and then a pullback. But yeah, that was a decent trade as well. Pound New Zealand, I'm neutral in that, so I'm not interested. You've got two weak currencies